welcome to the Capital Discussions Roundtable. I'm Tom Nonamaker with our guest speaker today, Jim Riggio. Jim will be talking about volatility skew for non-mathematicians, but before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So with that, I'll pass the ball over to you, Jim, and nice to have you talking about volatility, one of your near and dear topics.
Yes, one of my favorites. I thought about this, about how to end up going and talking what would make the most sense in and around getting everybody kind of up to speed for the non-mathematicians. So, for those of you who are, very much into volatility and skews very deeply, this is probably not going to be the presentation for you. But for those of you who sometimes get a little bit lost when I or some of the other folks go into heavy duty talking about skew and dispersion, okay, and how volatility ends up changing so many things. This would be the one that I wanted to do to try to get people up to speed. And so instead of starting any big presentation, what I thought is that I wanted to talk you through some of these things and actually show you where you can end up getting more information if you'd like to end up reading up more on these things. The best place that I would end up always telling folks to start is, at the beginning, okay? Many years ago, there was we needed to be able to talk about just the level of fear in the market. And what the SIBO ended up doing is that they put together a index on the S&P 100. Why? Because options traded a lot more back on the S&P 100 back then. Now it's all on the S&P 500. But what they ended up doing is that they actually took a bunch of different expirations, and they took a look at what options were trading at. And when they were trading, you take a look at their mid price, what they trade between their bid and their ask, and they use that to basically calculate a Black-Scholes type model, but do it backwards. Because for those of you that have read a little bit on, Black-Scholes or any of the other modeling, options modeling, pricing models, there are a bunch of inputs that you need to end up calculating, okay? And I'll tell you what, and so let's play a little game, okay? There's 5. Does anybody want to end up giving me what are the inputs that end up going into determining an options price? Okay, if you use a model, right? Tom, why don't you help him out? Why don't you give him maybe the first couple?
Okay, easy one is time.
Time is one.
Okay. Teddy said risk-free rate and stock price.
Rate. Stock price, time to expiration. Okay.
We're getting there.
Those are, okay. We also need to end up, this is a tougher one sometimes, okay. We also need to know, there you go. Thank you, Paul. Okay, dividend. Okay, you have to end up knowing the dividend. Now, when we ended up calculating these, okay, and Teddy, yes, okay, in order to calculate the price, you need the implied volatility. That's exactly what I was going to get to, Teddy. If I have all of those variables, and I can be missing one of them. If I'm trying, okay, the way the Black-Scholes models originally were built out was to put the volatility into the pricing model and out would spit out the price. But the problem is that, exactly, Teddy, he wrote down it's the biggest unknown. It's the only really unknown here because, right, we know what the risk-free rate is. We know what the stock price is. We know what the strike price is. That was the other one, okay, that we would need to end up figuring out a single one. We know dividend. We don't know implied volatility. The reason, by the way, if you actually read the papers, they don't call it implied volatility. They just call it volatility because they say you have to end up putting in the volatility to determine the price. Well, if we don't know the volatility, but we know what the market's currently trading at, we could actually put in the price, and then it ends up that price would imply what the volatility is. Okay, and so therefore, the term implied volatility, we basically kind of do a little bit of algebra or reverse engineer so that we put in the price, but we come out with the implied volatility. Now, we can come out with the implied volatility for every strike on every expiration. Okay, so we clearly end up getting that. But how to end up making this a little bit more simple for everybody, what the SIBO ended up doing was that they came out with a formula that actually at the original one used 8 different expirations, and they would end up calculating what an average 30-day implied volatility is. So let's start with this, because this is one of the things I think a lot of people sometimes use it so often you forget. What is implied volatility represent? So if I end up saying that the VIX right now is trading at, let's say 11. I know it's at 10.6, but let's say it's trading at 11. What does that 11 mean? Okay, anybody, go ahead, type into the chat. What does it end up meaning? Yes, it's average of 30-day volatility, but it is a 30-day look forward, and so you're using the options for basically a look forward of this is what we're pricing at it. But what I'm looking at is it's not quite time. No, Tom. It's but think about anybody know what the VIX or any implied volatility represents as a number? Because it's actually it's a helpful thing to know. How much the stock will move. Yes. Now, Teddy, it's telling you how much the stock's going to move, but how much over what period of time? What's the mathematical formula? Oh yes, there's 11%. Chuck said that there's 11%. Okay, price change in the SPX over 1 year. That's exactly what it is. Now, here's one of the problems, okay, and Teddy ended up putting in the variance, which is correct. So let's think about from a representative point of view. We need a standard measuring yard or measuring stick to be able to basically judge what the implied volatility is of, let's say, the June options versus the July options, right, or the May options, because they're different time frames. So we can't just simply say use the volatility of how much it's going to move between now and expiration. So basically what we end up doing is that they convert everything over to how much is the current risk or implied volatility, implying that it's going to end up moving, and then we normalize everything to a 1 year period. So when I say that the VIX is 11, it means that the VIX is representing that the S&P can move 11% up or down, it doesn't say which direction, up or down over a 1 year period. And I can use that when in the exact same language, whether I'm talking about the weeklies that expire this Friday, whether I'm talking about the May, June, or July's, or if I'm talking about the, like we use in our leap diagonal, the leaps, okay, that end up expiring at the end of 2018. Okay. By the way, leaps are just options that expire in more than 1 year. Okay. We tend to end up calling them, having them a separate name. So that's what it ends up meaning. Notice what I said before. I want to go back to some of the language that I used, and I want to parse it a little bit. I said that if the VIX is 11, it says that there's a chance that the market can move up or down 11%. Let's focus on that word chance. Okay, there's a chance that it can move, okay, and that it can move up or down 11%. And one of the things for those of you who remember a little bit of math, okay, basically what we're saying is that there's a 2 out of 3 chance approximately that it could move 11% or less. Okay, for those of you who do remember, okay, your confidence levels and your standard deviations, basically it said that underneath a normal standard deviation, okay, basically it's just a bell curve, okay, but it says that there's a reasonable chance, and we used to call them confidence levels, okay, 1 confidence level, 2 confidence, and basically some people, okay, mathematicians don't like those words because they're English, they'd rather use Greek, so they call them sigmas. Okay, and they'll talk about 1 sigma or 2 sigma. So basically, if you take a look at the probability that we will, what the VIX is saying, if it's an 11, they're saying that there's roughly a 2/3 chance, and I know you guys are going to tell me 68 point blah, blah, blah % chance, yes, that the S&P will only move 11% up or down or less. Okay, so obviously the greater that range, okay, the more the fear or more the optimism or more the expected move will end up being. And so what you're basically trying to end up figuring out, and the way the VIX ends up going, is that there were basically odds. Okay, if you've ever gone to, a racetrack and you bet on a horse and it was 4-1 or 2-5, you're looking at the odds of, and this is exactly the way the volatility and options came into play. The odds are that we would end up only moving most of the time. How do I define most? In the VIX, we defined it as a little bit more than 2/3. Most of the time, will only move 11% or less. Okay, I think that that's really, really key because sometimes, we throw around how things work or numbers without really understanding, their meaning or their background. And I wanted to be able to kind of go through that in a simple explanation without a lot of graphs, without a lot of Greek letters to be able to end going. Are there any questions about the simplicity of that number or the way that ends up working? Yes, one of the other things Teddy ended up typing in is that we don't have normal distributions. Okay, by the way, all a normal distribution means, it's a bell curve. Okay, let's talk non-stocks for a minute. Okay, we can do a bell curve of the average height of, person living in the United States. If we broke that down a little bit by, let's say, gender, okay, we would have normal bell curves for women and for men, and they would be a little bit different. Okay, you could also end up taking this same concept and changing, let's say, the country that you're doing your survey in. By the way, when I end up telling you this, I want you to end up thinking a little bit about this. It's almost like saying, well, we could end up taking a look at just the S&P, or we could look at the S&P growth stocks versus value stocks, right? So you can break this up to look at any, we call it a sample set, okay, any group of stuff, okay, group of people in a height. We can take a look at any group of stocks, okay. We can take a look at a group of a different nation if you wanted to take a look at how tall people are. And so when you take a look at those groups of people, it's a sample set. When we go and we're looking at how many, let's say, tall people there are, what you'll find is, the average height, and I haven't looked the numbers up, but, average height of an American male might be, say, 5'9". Okay. How many people are there going to end up being? A lot of those. So, are there going to be a lot of men that are 5'8" and 5'10"? Yes. Are there going to end up being a lot that are, let's say, 5'7" and 6 feet? Yes, but they're going to be less than of them than at the very center. And so what ends up happening is you get this traditional bell curve. And all the bell curve is that we're going to do counts. How many, U.S. American males are 5'9"? And we'll get a count of how many of them are that tall. How many of them are going to be 5'11" or or 6 feet or 6'1"? And we'll get counts. And what will end up happening is that right in the center, what you'll end up seeing is that they'll be the most. and then there'll be less as we go on. And so if I end up taking a look at, and I just want you to see, bell curve, okay. I just want to get a picture of it, okay? So what you'll end up seeing is that in the center, this is going to end up being most people, right? And the average person is going to end up being whatever that number might be, 5, 9, we end up saying. And if this is just a count, how many times this happens, and as you go up or you go down this curve, there are going to be less and less people. So if you come up here at the very, very top, how many 7-footers are there going to end up being, right? People, men who are 7 feet or taller. Same thing is how many of them are going to end up, say, being, 5 feet or less, okay? Very few. And so the further you get away from this curve, from the center, the less likely it is for it to happen because it would happen much fewer times. Now, here is probably the single biggest difference from in investments, okay? And when we take a look at markets versus the height of people, right? And most things, right, the height of people, you can end up taking a look at how long, I don't know, the average car will last. You can take a look at how many rainy days that you have in a particular region. You can take a look at just about anything, okay, or many, many things, and you'll see an average normal distribution curve. Yes, sometimes there are different types of distributions, but this is the one that's most common by far, okay, the simple bell curve. Now, the problem is, and you guys know this, right? Can the market, have you ever heard the expression, the market takes the stairs going up, but the elevator coming down? Meaning that when we go up very in smaller bits, okay, or in smaller steps than if the market ends up selling and it comes off. Now, the problem with the markets is that human emotions come into play. And what ends up happening is that when the markets go down, many times you get panic selling. And it tends to happen in very short periods of time. When the market goes up, yeah, sometimes you can end up getting a frenzy of buying, but it usually ends up happening over a longer period of time. So when you take a look, if our measurements period, if we were to end up putting in the percentage gain and the percentage lost in a single day of an index, and we mapped this out, what we would find is that the short days, right, the days that we went down, there would be a lot more short days that, let's say, that were more than 3% losers than there were 3% gainers, okay? And in that case, what ends up happening is that this nice, smooth, symmetrical-looking curve no longer is a symmetrical-looking curve, because what happens is that there's the possibility that the markets end up dropping off much, much quicker, okay? And so what ends up happening is that you can take a look at, different examples of this. And I know that you mathematicians would probably love to have the conversations about Poisson distributions or fractal distributions, and we can end up doing that. And for you guys, there's a great book that I ended up really liking called The Physics of Wall Street that you should go out and end up reading, and it goes through the history of a lot of this stuff. But again, this is not I didn't want to do a heavy duty mathematics one. I just wanted you to understand the reason why. We're going to take a look more at the VIX and the VIX products, but the reason why there's going to end up being a skew, and you've heard that word so many times. So what ends up happening is that since the Black-Scholes and every other method was really built around mathematics and things being normally distributed, how do we end up pricing these things if they're not normally distributed, okay? Every one of these things gets priced individually. So like I said, the occurrences okay, of how many times the market's moved down 3% or more has occurred a lot more than how many times the market's moved up 3% or more. Now, that's very, very different because if you take a look at how many times the market's been down 0.1% versus up 0.1% here, those aren't going to be that different. As a matter of fact, that's actually going to be leaning a little bit more, right? Because the market has gone up more than it's gone down over history, it means that on the center line of 0, okay, we're actually going to have more plot points on the right-hand side than on the left-hand side, right? Because we're going to have more up days, you would end up thinking. Well, what ends up happening is that the down days are so severe that the way this curve actually looks, if I was to plot out all of the stock prices, is that this little area in here right above 0, it's going to be a little bit higher than normal. This little area down here, well below 0, it's going to end up being a little bit higher. So this distribution, or the number of counts that come out over here, this is going to be higher. What ends up happening when you look at this graph, okay, this line that goes out to the left is going to be a little bit higher than the line that goes out to the right. And because this line that goes out, okay, this distribution or this curve line that goes out to the left is a little bit higher, you've probably heard these things called fat tail distributions. And what that ends up meaning is that in simple English, the markets, when they go down, they can go down very, very quickly. So when we take a look, how does all of this play into what we end up doing in skew and what that ends up meaning? Let's go and take a look at the following. Let me get one over here. I just want to take a blank. Sorry, I didn't have a clean one. I just need to end up getting a clean screen for you. Okay, so let's bring this down over here so we can see this. Okay, so what you're looking at on any type of Thinkorswim or any other screen, when we take a look, and let's go take a look at a 30-day option. Okay, so when we take a look at a 30-day option, and we're looking at this implied volatility right here. What this implied volatility of that I have my mouse right under, the 8.7675, right? You can see it's moving, but it's this one. What we're looking at is that we're looking at the money. You know what? Let's use the 2400. I'd rather use that because it's probably a little bit better. So we'll look at the 8.67. What we're looking at is that this is the volatility that's calculated using the mid price of the bid and the ask. And so right now, okay, this 2400 is being priced as if the market would not move, 2/3 of the time, would not move more than 8.65% in a year. Okay, so that's pretty low. Now, that's what the current price at the VIX, you would say, well, hey, isn't this what we should end up using as the VIX? This is the 30-day option, and it's at the money. Isn't the VIX the 30-day option and the average? And so shouldn't we use at the money? The challenge that the guys at the SIBO had is that they said, well, we need to take in a larger sample set. We can't just look at just the put at the money 30 days out. First of all, when they ended up doing this, there weren't weekly options that expired on, on Wednesday and Friday of every week, and now on Monday. I mean, it's getting ridiculous. You can end up pretty soon they'll have options, okay, and you could actually get ones built for you if you had enough money and you wanted to end up investing in them. But this is what the implied volatility of the at the money is. Now, if I take a look at, well, you say, well, Jim, how about the calls? Shouldn't we take a look at the calls? Well, here's the calls. The calls are only at 7.24. Okay, so if I was to average the at-the-money volatility, the VIX wouldn't be at, which it is right now, it wouldn't be at 10.6, okay, or 10.5, I guess it's at right now. It would end up being much lower. Well, what they end up doing in the VIX is that they take a sample set of options longer than 30 days, okay, shorter than 30 days, above the money, below the money. Okay, so they'll take a look at what the implied volatility is of some of these options and some of these options. How do they end up calculating it? I don't want to get into that because then I'm going to get into math, but let me just summarize at an extremely high level that they're going to end up taking a look at not just the 30-day options. They'll look at all options. By the way, they only changed that, maybe about 5 years ago. When weeklies first came out, they didn't use the weeklies. They would only use the monthlies. And they would have to calculate everything off of the monthlies. They started to end up using weeklies, but also, do you want to end up using the implied volatility of every single option? No, you want to use the ones that are going to be, somewhat closer to the money. Not at the money, but you want to take a sample set. You want to take a look and see, what options are most traded, and then you want it to be a representative set. Now, the problem with this is that if I look at the VIX gives me a single number, okay? If you want to know probably the single biggest change of what's happened in implied volatility over the last 5 years, it's that when the single number, when we look at the entire, VIX calculation, what we find is exactly what we're seeing today, that the implied volatility of what's at the money, if I go to the 30-day option again, right, because I want to just stick with the 30-day for right now. The single biggest change in pricing of options, and this affects, your trading, is that when I take a look at what the options cost at the money, they have gone down in a relationship to the VIX. What used to end up happening is that if I looked at the VIX and I looked at the put and the call at the money, they were 5 or 10 years ago much closer to the VIX than they are today. Okay, so what ends up happening is we take a look at the average of these two prices here, the 8.77 and the 7.3, you're probably going to end up averaging those things somewhere close to about 8. Okay, just rough math, right? Somewhere close to 8. The VIX is actually, right at this moment, it's at 10.6. And so think about that difference. We are at a 2.6 difference, right? The average here is 8. The VIX is at 10.6. We're at a 2.6 difference. Now, when you take a look at 2.6, and if I expressed it to you as a percentage, instead of saying there's a 2.6 point difference between the put and the call at the money and the VIX, if I did it to you as, well, what's the percentage, or some people like to call variance, 2.6 divided by 10.6 is like 2.5%. Okay, I'm sorry, it's about 25%, right? 2.6. Okay, and so when I take a look at it, is a very, very high percentage difference between where in the individual options at the money are versus the VIX. Okay, so now why is the VIX higher than at the money? Okay. Give me an answer. Why do you think that the VIX is higher than the put in the call at the money 30 days out? Exactly, Chuck. It's the skew. In English, let's take a look at, without using any math again or skew. If I go and I take a look at what happens with the implied volatility of the options, if I go lower, right? If I look at a strike price lower than 2,400, what we end up seeing is you can see here that the implied volatility ends up going up, rather significantly. Let me move this down so I have some more room here. Okay, what I can end up seeing is that the implied volatility as you go higher on the page, by the way, which is lower on strike price, right? This kind of messes some people up. I've been looking at it so long. Usually you start at a very low strike price at the top of the page, and the strike prices increase as you go down. So the strike prices go up as you go down the page. Okay, so what ended up happening is that these became much higher. Okay, now this wasn't always the case. Okay, they used to be a lot more symmetrical. There were firms, okay, like Citadel and others, that ended up probably O'Connor and Associates was one of the very, very first that realized, hey, when the market goes down, okay, they ended up realizing that the implied volatility should be higher on these strikes. Now, they were kind of smart, right? They didn't publish academic papers or do anything. They kept this to themselves, and they traded it, and they became, multi-millionaires over a long period of time because they ended up realizing this. And so these things had been, I don't want to call them priced incorrectly, but they weren't priced to what the true odds, okay, would end up being. Today, the true odds are very, very true. There have been, in my opinion, three major shifts, okay? The first shift happened, okay, back when O'Connor and Associates got found out, and this kind of changed a lot and their edge went away, was during right after the 1987 stock market crash. And what happened was that people realized, hey, we should end up paying more for these options below the money, because if I come back to the standard deviation, I know that it's not a normal standard deviation, meaning that, or a normal distribution. We can have losers. We can have a lot more down days than we can have up days, okay? And so if I take a look at how do you end up representing that in the market, what ends up happening is that the pricing, okay, for a options, and let's take a look at this, okay? Let's take a look at what the price is 100 points above and 100 points below the money. So we're going to end up looking at this very simply. Let me make this as big as I can here. Okay, so what we're going to end up doing is that we're going to look at the 2,300, the 2,400, and the 2,500. Okay, and what we'll do is to make the options, okay, and deal with the separately. I'm only going to look at the out of the money options. We can look at both of them, but you'll see. So if I take a look at what the implied volatility is of the 2,300, I'm at 1231. Okay. If I take a look at the implied volatility at the money, I'm only at 9%, right? 8.97%. And so again, remember that is what the market is pricing. A 68% chance, or 2/3 of the time, they think it's going to move this much or less. But they're going to end up having a premium. They're going to have a higher price because they know that the market could end up going down more often, or can go down faster than it goes up. Where on the upside, if I take a look at the 2,500, okay, here I'm priced high also. But here's why I'm priced high, and this is what I want you to end up seeing. I did this at 100 points. 100 points is a very, very big move, and we're out of the realm of normality. If I only looked at a 50-point move, Okay, I want you to take a look at a 50-point move at 50. Take a look. Here the implied volatility is even lower than at a 100-point move. So what it's saying is that it's very common for the market to move, right? Because think about this. It's going to have the lowest implied volatility of where they think it's the greatest chance for the market to move. And so if I take a look at where they think that the greatest probability is for the market to end up moving, it's going to be that it's drifting higher. And so when you end up taking, it's also, don't forget, it's also it's priced by supply and demand, not pure probability. But the probabilities are pretty accurate. I mean, the guys who price these things have been doing this a long time, and the ones who've priced them better become extremely wealthy, and the ones who didn't end up pricing them very well have, not done well at all in terms of their career. So when I take a look at what the implied volatility is right here in this column, what you can end up seeing is that the implied volatility will go down, 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 and then we get to a point where right here, right here, where it starts to go up. What ends up happening is that these options become so inexpensive in terms of their price, say compared to these, that the slightest little change, adding a nickel, okay, to the bid ask of the 2440 is going to, in the call is going to have a much bigger percentage change than, say, looking at the money, right, if it moves a nickel. So what ends up happening is by paying just a little bit more, especially when you come down here, right, 55 to 60 cents, by paying just a little bit more, okay, for these things, you'll see that the implied volatility comes down. Now, if I was to end up plotting, okay, this all on a curve, and I can't do this because I'm not in my home office today, and I'd want to end up showing it to you in live. I can show this to you here, but it's not the smoothest curve. So let me end up doing this. Let me go and take a look at just the 30-day option, right? The 30-day option we were looking at was the which one was it? We're looking at the May 26th. Okay, so if I come and I take a look at the options, what I'm going to do is I'm going to end up selecting just the May 26th, right? I just want to look just at the 30-day option. Okay, and what I'm going to do is I'm going to end up taking a look at all strikes, and I'm going to look at just the out-of-the-money options. What you're looking at on this single line is here is basically, if you will, the VIX for each single strike price. The strike prices are along the line back on the bottom here, and this is the implied volatility or the VIX for the individual line. So when we take a look at the 2400, right, and do I not have the right one? I have the weeklies. I'm looking at the out of the monies. I don't know why this is where oh. No, it should be. I was on options. Oh, okay. I don't know why I didn't have it. Maybe I was looking in the wrong place. But here's the 2400. Now you can always see, by the way, instead of me doing all, let me see if I can just do maybe 50. Okay. When I take a look at 50 strikes, okay, 25 up and 25 down, normally you're going to end up seeing, okay, in a lot of software, this type of change in the line. I'll get to that later. I don't want to end up focusing on that. I just want you to tell you it's not an advantage. It's just, if you will, it's almost an optical illusion. If I come and I take a look instead of the out of the money, I'm going to look at just the puts. You can end up seeing it doesn't happen there. If I come and take a look at just the calls, you can see it doesn't happen there. But you can see that there's a lot of noise in this line when I look at the calls very deep in the money. You can also see that if I look at the puts, okay, out of the money, this thing goes way up here, and that's not accurate either. So what is most accurate Okay, what's most accurate when you're looking is to look at the implied volatility of the out of the money, okay, options. For those of you who are not familiar with the OTM, okay, all it means is that I'm looking at a put when I'm looking below the money because there's no, we use the term intrinsic value. Okay, and I want to end up introducing, okay, this term intrinsic and extrinsic value. Okay, I think it's going to be very important, and I'm not going to do that now. I'm going to finish what I'm doing, and I'm going to end up talking to you about this, and then I'll explain this also. So what I'm looking at when I look at the out of the money options now, the market's moved up a little bit since we've been talking, so the 2400 is now in the money. If I take a look at the 2395. It shows me where the implied volatility of that put is. And so they plotted the point for the 2395. They also plotted the point for the 2390, the 2385, the 2380, and so on, right? Every 5 points going down. Each one of these, there's a plot point here, and they've just drawn the line. And so what you end up seeing is that this is a pretty normal or straight-looking line until you get closer to the money. So if I go and say, instead of looking at 50 strikes, let's look at 100 strikes, 50 up and 50 down. So what ends up happening here is that this line looks relatively straight. Okay, it starts to end up curving, and then when we take a look at just the calls, it starts to end up moving, and this part of the curve here. Let's go back to where I just wanted you to see by both more strikes, it stays relatively straight. And so the puts are pretty easy that way. If I go back to 50, what I want you to end up seeing that in this curve, this part of the curve right here, it comes down and then it starts to go back up again, as we talked about, because of the lower price point of the calls. This is a part of the area that Paul Demers and I affectionately call the belly of the curve. So one of the things that you'll want to take a look at is, and this is easy to end up looking at without any specific tools, where's the lowest implied volatility? So if I come back over here, okay, and I take a look at where's the lowest implied volatility of the of anything on the call side, the lowest implied volatility is right there at 2430, right? It's 218. I'm sorry. Got my numbers wrong again. It's 7.18. And you can see here that sometimes it'll end up moving around, okay? But you can see that there's a cluster of very low numbers here. What's happened, okay, remember I told you there were 3 incidences that have changed options. What's happened most frequently is, and the third, by the way, 3 things are, so there's no suspense, right? We talked about the 87 crash. 2000 ended up changing things a lot, but there wasn't really a true single event, fear crash. It was really 2008 that changed things. And what's changed things much, much, much more, in my opinion, for us, is that the high frequency and the computer-based algorithms are trading the options now at a much higher mathematical level than they did in the past. When did this start to occur? After 2008, but the high-frequency guys really got into things, I'd say, about 5 years ago. It took them probably about a 3-year period where they really got in, and all of them were in at this point. And things have changed for the last maybe, close to 2 years, I'd say. And so what's happened here is that this is the lowest implied volatility. If I come over here and I take a look at the implied volatility of the puts below the money, you saw that these numbers, okay, were represented as they increased pretty symmetrically. So, and that's why when I take a look at it, a lot of times instead of looking at a graph, it's easier for me, because I've done this so long, is to just look at the curve, okay? Look at the curve and see if there's any abnormalities in the curve. Let me give you an example of an abnormality in the curve. What can end up happening when we went into the British exit vote, right? We called it the Brexit vote, into the U.S. elections, and to a smaller extent, even the French elections that were held, over this past weekend, is that there was a lot of demand to buy puts a little bit below the money. What's a little bit? Maybe 2 to 5% below the money. So this nice smooth curve, you saw it, by the way, change, right? That's bid and asks coming in. But this nice smooth curve, when you don't have Captain One-Lots distorting individual prices, there was a bump in it. There was a bump in it from around 2% to 5%, and the bump was very evident in the line if you were looking at specific tools. That was because there was a lot of fear in the market that needed to have protection in case something happened. And so this line wasn't smooth. You can end up running all the tools you want, and I found that I've done this long enough, and you can do this long enough to end up noticing what this line looks like. And if there's any abnormalities, meaning it's not straight. Now, I'm not saying it's higher than normal, lower than normal, or it's pointing further, it's pointing further up or down. I'm just saying it's not straight. That was an abnormality. What's happened after 2008 is that there was even a greater demand placed on puts far below the money. So what that ended up doing, if I look on this curve, it drove this part of the curve, the lower part of the puts, drove it up. Now, remember, when I say it drove up the curve, think about what I'm saying. I'm saying that the implied volatility was higher for the puts as I went further and further down in strike prices. The implied volatility, again, never forget the implied volatility. It's what the market is pricing using Black-Scholes, whichever model you like to end up using. It's pricing, what they think the market would be statistically happening about 2/3 of the times. It'll move less than this. So when you take a look at these, each of the options are priced individually. So that's what ends up happening. If I was to say the exact same thing on the graph, what I'd say, what happened after 2008, similar to 1987, is that the implied volatility that you can look at these strikes became greater than at the money. Now, you can do this in tons of different ways, right? You can spend a lot of money on different tools in different ways. Here's the way it used to be done back when market makers used to have to do all of this stuff in their head. You pick a point. What point? You pick a point on what's important to you. Don't pick a point that somebody else tells you have to pick. So if you end up doing butterflies, and a lot of times, you're picking a strike that's, say, 50 points below the money, what I would end up doing is I'd take a look at what the implied volatility was at the money, and that's right here. And then I'd go 50 points below 23.90 down to 23.40, and I'd take a look at what this implied volatility is. And I'd calculate that as a number. That would be it. That's it. That's all I do. I would take the 10.56, and I would divide it by the 9.02. And that's what I would look at. And it's a number that you can calculate all the time. It's a number that you can end up taking a look. If you're good at Excel, you can end up building that. And that'll give you an idea about the difference in implied volatility. Now, here's the problem. What happens if you don't use a 50-point wide spread? Maybe you're putting your shorts 100 points below the money, or maybe you're putting them 10 points below the money, but you have another short someplace else. That's why when I take a look at this, where is there an advantage? My eye is not good enough. By the way, I have met traders that could end up looking down the numbers, and they can look down the numbers and pick out which one's out of sequence. Why? Because they've been looking at the numbers just so long, I haven't been looking at the numbers so long. I kind of grew up when I could already see a graph. So what I can see, it's also a lot easier for me to see a bump in a place if it happens. Okay, so this is what implied volatility is. This is what we mean when we talk about skew. We're talking about the implied volatility at different strike prices end up changing. Now, I've talked about abnormalities. Let's get into any general questions, because I want to get into how the market makers have changed our game, I think forever, over the last 5 years or so. I'm seeing other questions. Tom, I think I got most of them. I don't know if I missed any.
Yeah, there haven't been any for a few minutes.
Yeah. 5 or 10 years ago, we never had weeklies, let alone all of the other VIX instruments. Okay. Yes, Jerry, I'm going to end up, oh, it's Jerry first. How you doing, Jerry? I'm going to get into that into a minute, because the thing is that it's really been over that time frame, like I said, starting in that 5, maybe a little bit more, it really ended up changing things. The 2008 was the catalyst that ended up doing this. Yeah, I think I got them all. So what ended up happening after 2008 is that, well, let's go back just a little bit, okay? After the 2000, okay, the SIBO realized that they could end up making a lot of money if they were to end up actually having products that you could end up trading in and around volatility. So what they ended up doing is that in 2004 and 2006, and I'm doing this from memory, so I know somebody's going to correct me if I'm wrong. In 2004 and in 2006, they introduced VIX futures so that you could end up trading futures and VIX options. Okay. Now, the VIX options, they didn't want the VIX options to be priced off of the futures. Why? Because now, if you're going to trade futures, okay, for a living, okay, and you're an institutional guy, you have to be, a CMT, and you have to register with the CFTC, and it's a lot different. It's not the same as registering with the SEC and FINRA and becoming a registered investment advisor. It becomes more complicated. So what they end up doing is that the VIX the VIX options, they said and it's true, that they were going to be price settled off of what the VIX was. When they made this introduction, it was used by futures traders and heavy-duty options guys. It didn't take off immediately. It was difficult. If you were just sorry about that. If you were just a regular Joe and you didn't have any of these, fancy accounts back in 2004, which most people didn't, you couldn't trade any of this stuff. And so the same thing in 2006, unless you were an options guy and you understood how all of this worked, this was for those big institutions, and you never had a chance to end up really, really trading these. So what ended up happening? It wasn't that big of a deal because nobody thought that there wasn't a huge amount of volume. They didn't think people would end up trading it. 2008 occurred, the second of the three big things. When 2008 occurred and the market sold off and everybody saw the VIX go through the roof, and they started calling it the fear or the panic indicator. And it was guys originally at Credit Suisse who ended up saying, hey, if we could end up selling, okay, something that, a VIX-based product, okay, to the general public, we could make a lot of money. But there was a problem, right, because the VIX is the only futures that I know of in the world where you can trade it against its underlying. Like, for example, if you were to buy gold futures, you could trade it against the actual gold. If you wanted to end up buying oil futures, you could, okay, if you wanted to take the physicals, you could actually trade it against the actual spot price of gold. Of oil. And you could do this with bushels of wheat. You could do this with, U.S. Treasuries. You can do this with, German bunds. You could do it with just about anything. But you can trade the price of the VIX. So what ended up happening, okay, as Jerry ended up mentioning, in that 5 to 10 years ago period, was that there was such a demand not just from the institutional guys, but from the average retail trader to be able to do this, they started to come out with these VIX-based ETFs and ETNs. Now, what that ended up doing was that normally in every other marketplace that I know of, the dog is not wagged by the tail, okay? The price of oil is driven by, the actual supply and demand for it. Okay, it has to end up doing with economic factors. There are traders that will end up doing things, but it will end up being the futures, okay, that are more liquid. And so they tend to move quicker, but they tend to end up forecasting of what's going to end up going on. Remember, since it could always be arbitraged against the underlying, it could only move so far. Now, that arbitrage, okay, and let's just talk about arbitrage for a second. If the S&P, the 500 stocks, are trading at 2,400, and right, if I added all the stocks up and I added all the price and I did the math because it's a capitalized weighted index, and I calculate what the bid and the ask is for all 2,500 stocks, and it comes out to be $2,400. If the futures, and I'm going to take interest rate and dividends because I know otherwise you guys are going to be upset at me if I don't, but I'm going to put those to the side and say I calculated all of those into it. If the futures are trading at $23.95, I could make myself a quick $5 by buying the futures and selling each of the 500 stocks. Now, if I could make $500 doing that every time I hit enter, okay, for the trade, how many times would I hit enter? There's an old expression, until my fingers bled. I'd hit it as many times as I possibly could. What would end up happening is I keep doing it, and pretty soon I wouldn't be making $5 anymore. I'd only be making $4.90. Right, because the thing is that I would be buying one and selling. I'd be buying the one that's undervalued, selling the one that's overvalued, and I would drive them in, and I drive them and drive them and drive them until there was no more edge, there was no more difference. What ended up happening is that computers now do that, and they do it so quickly that a human being doesn't have the possibility of even playing in that game anymore. Okay, so that's the way the arbitrage ended up working. Now, here's the interesting thing. How does this work? And the reason why I said this is, how does this work if you can't trade the underlying? Now, I can't end up buying and selling each of the hundreds and hundreds and hundreds of options that they end up, the individual options that they use to end up calculating the VIX. So now what ends up happening is that the VIX futures, because they've broken apart from the underlying, the VIX futures are free to end up trading in whichever direction they end up thinking. Now, is there a pretty tight relationship between what the VIX, remember the VIX is determined by the bid and ask prices of all of the options that are used in the VIX index, is that relatively close to the actual VIX futures? Yeah, it is. Does it vary a lot? Yes, it does. Okay. Can we tell the difference, or does it give us any hints about if one moves faster than the other? Yeah, it does if you study it long enough, okay, with other factors. There are clues into how the bid and ask prices of these three things all work, okay? And here are the three things, okay? I'm going to say implied volatility, but I'm going to break it up into two separate pieces. The first one is the implied volatility at the money versus the implied volatility below the money, okay? And so when I take a look at the VIX, remember, it doesn't tell me. If let's do a super simple example, okay? Let's say if the at the money were at, 8 and the below the money were at 12, the implied volatility. And my VIX calculation, because I'm not very good, they are going to do what I did before, right? I'm just going to take two prices. And so they're going to say 8 and 12, the average is 10, so the VIX is going to end up saying 10. But if these options over here below the money have gone up at a much greater rate than at the money, that tells me that there's more fear, okay, of a potential bad thing happening. Now, what happens if the options go up more at the money. They never go quite up more at the money than they go below the money. But what happens if they go up much more than normal at the money? That usually is saying we're starting to realize the fear and things are getting bad. Okay? No longer, if we've already dropped 4%, do people want to end up buying options 4% below the money. Now they might want to buy at 2% or even at the money. Okay? So you can see from a human emotion or just thought process that they're going to end up buying their options at different points depending on where the market has come down and their fear level of where it's going to go to. Okay, that's very important, where it's going to go to, because don't forget, that's what we're always talking about. So when you end up taking a look at that, the three different things that I take a look at is what the implied volatility is at the money, and some people just might want to use that as the VIX, what the implied volatility is below the money, and that is whatever custom skew formula you want to end up using, and then you compare those two things to where the actual VIX is trading. So let me show you a chart. Can you actually see this? And the answer is you can. I just need to get a chart out over here. Oh, sorry, I'm on a different laptop. I never used this over here, and now it's a minimize this. Cool chart. Sorry, I'm much slower on this, I know, than I normally am. Detach. Okay. So what I want to end up doing, I don't want to look at this. I want to look at something very simple. What I want to look at is, and I'm going to do this. I'm going to look at the VIX. I'm going to plot out the VIX. And we're not going to look at, let's get rid of all of these studies. Let's get rid of all of these. And what I want to do is that I want to compare it, right? I want to compare it to where the VIX futures are. Now remember, they're supposed to end up meaning kind of the same thing, right? They're supposed to end up meaning what's volatility going to end up being in 30 days. And so let's take a look at a compare function. Okay, and let's take a look at, we're going to compare them to the VIX futures. And when I put in VX, okay, for the users who don't end up looking at this, VX says VIX futures. Now, normally VIX futures, okay, you have to do the same thing. You have to say which month or which settlement date you want to trade. When you don't put any settlement date, it defaults to the first. It defaults to the first month, okay? And so I will end up doing this. I'll hit this. Now, I don't want to look at all of this time. So let's just look at, let's say, here. I'm going to take a look at 3 months. I'm going to look at a daily number. Okay. And so what I'm looking at here, and I have a percentage, so I need to do one other thing. This is another think or swim benefit that they end up giving us. They give you the percentage change from one to the other. I don't want to look at them in percentage changes. I want to end up getting percentage change off. So if you guys ever do that, that's where you have to go, right? Price, okay, you go into your settings, price access, get rid of it. And then after I do this in any chart, the first thing I end up always doing after price is I put this button here so I don't have to go through it again. I'll show you in a second. Okay, so if you take a look, you can see how the implied volatility, because that's what we're measuring, right? This number over here is the implied volatility as determined by the VIX versus the implied volatility of the VIX futures. And so when you take a look at the difference between those, there's going to end up being, a very big difference a lot of times. Now, the challenge that we end up finding, okay, when you look at the VIX, okay, and this is why I'm giving you the reason of what is going to be one of the most important things you're going to walk away with, okay, and I want you to understand why in non-mathematical terms. Okay. The VIX is priced right here in green, right? This is what the plot price is on a daily basis. If I wanted to, instead of looking this on a daily basis, I can plot this over the last 5 days and take a look and see what the actual volatility of the options, what the options are dictating the price to be. So if you take a look at the VIX right here, okay, in the bar chart or the candles, you can see what ends up happening as we were going into Friday. Now, Friday not only was expiration, but it was also the weekend before the French elections. And you can see how much more the VIX dropped than the VIX futures. The VIX will move quicker and have more noise in it than the VIX futures. And I want you to think about that for a second, okay? The VIX futures will have a lot less noise. Why is that? Because the VIX is calculated. If we have some large order, okay, coming in to buy a specific put or a put spread or any set of options, you're going to have this number calculated, okay, in our case, every 5 minutes, okay, to be able to plot it out on that chart. So you're going to have order flows for massive buying, for massive selling, and it's going to end up having some places where they're really strong at the money and maybe less below the money. So it's going to end up changing their calculation. So you get the VIX to move an awful lot, okay, a tremendous amount. So what ends up happening, okay, is that the VIX futures, okay, and if I came over here and I took a look at the VIX futures, right, the VIX futures, if I take a look at just /VX, right, the VIX futures are just that. They're just futures. There's no options. There's no, that means everybody, okay, by the way, right here, see how it says active? And I just typed in VX, so I went for the VIX futures, but it's putting in the active contract. I'm not going to end up going into this now, but I've done it in other seminars. K is the month, okay? K happens to stand for the current month that we're trading in, okay, which is the May futures, okay, because that's the active contract, and 7 is the year. However, I'm looking at a single contract. I can also end up looking at, okay, all of them. Now, they won't give me all of them on a single screen. I actually have to page down. But you can see here, here's the active contract. These are weeklies. I'm not going to talk about weekly contracts on VIX. Their volume isn't nearly as much. They're not used as much. But you can see there are all of the VIX contracts. So here's the next month, okay, the M7. And that's going to be the June contract. You can end up seeing here that the N, as in Nancy, is 84 days, and it's the July contract. Now, this is the third part. Okay, remember I told you we took a look at volatility, implied volatility at the money and implied volatility below the money. What we also take a look at is how much people are willing to pay for a VIX contract. Now, the VIX trades, as you saw, okay, the VIX futures contracts trade is smoother than the VIX. The VIX has more noise in it. What does the VIX give us? We need to extract the noise. What's the noise telling us? The noise is telling us, okay, how much people are willing to pay for protection below the money versus at the money, and that's going to give us a hint. The other thing is, what are people willing to end up paying for protection as you go out in time? Okay, and this is a much smoother graph. So we look at these things, okay, to be able to end up having an idea about where the market's going, and there's a lot of clues in this stuff. This, by the way, is where I've spent, nearly a decade, okay, in studying, okay, that stuff for the Vol Vantage trade, because many times they leave little tiny hints, okay, when they're doing stuff in here. So let's go back to, though, I wanted to end up showing you that as an example of just, there is depth in the market. There are a lot of different areas that come into play. Let me go and answer a few more questions. We're at a decent point. How do I use this IV info when I'm trading spreads? Great question. Okay. Let me give you an example. And I had built out a whole hedging class with Paul Demers. I just never finished it. I need to finish it. I know that a lot of you guys wanted to end up saying things, but you need to end up using this information when you are trading, right? How do I end up using it? So I'm going to show you how I end up using it when one specific thing happens, right? I think a good example. So let's talk about if you wanted to end up building a hedge for your portfolio. Okay, what would be the best hedge? If I go out and I take a look at, and let's use I want to use a 60-day. So let me use this option. You know what? Instead of that, let me use the quarterlies. I want to protect until the end of the quarter. So one of the things that will end up happening is that if I am a good consumer and I know my pricing, right? And we've talked about this in other things. It's if I know and I've calculated this for a long, long time, and I take a look and see, well, the implied volatility is 10 here, but if I go 100 points below the money, it's only 12. Now, by the way, I'll tell you this. You say, oh, Jim, that's less. As you get closer to expiration, okay, very important, as you get closer to expiration, the difference between the at the money and far below the money, it will increase. The difference between this implied volatility and 100 points below the money volatility will increase as you get closer to expiration. Let me show you how you can see that in your actual example. Again, let me come over to here. We got rid of everything. We were looking at the May 26th, and we were also looking at the quarterlies. And we were looking at 50 strikes, implied volatility out of the money. Okay. So here's what I wanted you to see. Okay. This blue line is the one that I just drew, right? That was the quarterly expiration. This pinkish magenta color line is the one we were looking at, the 30 days out. Look at the steepness of the pink line, right? If you put a ball on either one of these curves, obviously the ball on the lower curve on the pink line would go down a lot quicker, right? Because it's much steeper. This is normal. This is normal. This happens all the time, okay? Whereas you get closer to expiration, okay, this ends up being different. Now, what would end up happening and how would I end up using this information, okay, when I trade? For example, if for some reason this blue line or aqua color line was much steeper than what it is right now, because I have tracked this for a long, long time, and my implied volatility is very, very high down here, and it's not as high over here, what would end up happening, I would want to end up, think about this. Here's what you're always trying to do, right? I don't think you need to take notes on this one. You want to buy low and sell high. Right? So what would I end up doing? So if historically this is lower than normal, or say this is just normal, but historically this blue line at this point is much, much higher than normal, well, I'd want to sell that. And I'd want to buy this one. So I could buy something at normal price, sell it at something super expensive. Now, what is it when I buy a put at the money and I sell one 100 points below the money? That's a put vertical, right? That's a put vertical. Okay, there are times with all of the super fancy computers that the guys at EAB and the other institutions use, there are times when the single best hedge you can ever put on to protect the S&P 500 is simply to buy a put vertical. Unfortunately, that probably only happens about 5% of the time. Okay, if it happened 95% of the time, you'd never need anybody to end up helping you to hedge. You'd end up doing it just yourself. Okay, and so that's the way I would take a look at it. I would take a look at what's normal, what part of the curves are more expensive than normal, what parts of the curves are less expensive than normal. And what I try to end up doing is that I try to end up always buying the cheap parts and selling the parts that are expensive. There's a reason, by the way, for those of you guys who have subscribed to the Kevlar service, there's a reason why I have two different entry modes. Okay, and it has to do basically with this line. I'm going to put on the trade that takes advantage of this line more. Now, does that end up, okay, meaning that we're going to win every trade? No. Does that end up giving me a little bit of an edge statistically? Yes. What does that little bit of an edge statistically end up meaning? It helps my annual return. It doesn't mean that I'm not going to have losers. It doesn't mean that I'm not going to have down days. It doesn't, there's no guarantee. All we're ever trying to do, okay, whatever I'm trying to do in the Kevlar is give myself a little bit of statistical edge, okay? How can you see that? Well, people take a look at, well, what are your winners and your losers? It's a lot more than that. You have to take a look at how much you're winning when you're winning, how much you're losing when you're losing. But it's going to give you a statistical edge. I believe if I don't have a statistical edge, I don't want to end up trading it. Now, the great thing, by the way, remember I told you, going back to the three things, the third thing is the computer-based algorithmic trading. If they take the advantage away of buying puts at the money, like they have, and they've driven the price down here. However, right, if they've driven the price down here, it's almost like a game of whack-a-mole. They can't suppress everything every place. What ends up happening? Sometimes the price moves up over here below the money. And so if they take away one trade, they're going to end up almost by definition exposing something else. And so what do you end up doing? You try to take the one that gives you the greatest edge, the greatest probability. Sometimes that's only small, but you take what you're given. Okay. So that's how I end up using this. Another question is your IV and my IV on May, okay, we're showing 9.06. Okay, somehow I don't have the fastest internet here. I did end up having a pause at one point. It was probably my system. The implied, and it was the same thing. If you remember, I was looking at the graph. I couldn't end up getting the graph. I had to go back and reset something. But that was a timing difference. I don't think that all systems should be almost the same. It says Jim has the volatility calculation mode set to IV. Okay. You have a volatility smile. Okay, so let me go back to what we were looking at. Okay, I assume that this is what you were talking about, an implied volatility. Right? I'm looking at implied volatility. I can plot a bunch of different things here. What I'm plotting here is implied volatility. The reason why they call it an implied volatility is that a smile is because usually the corners are higher than the middle. Now, in equities, okay, the smile, we always called it a smirk, right? Because one side was higher than the other, okay? Volatility. Does anybody know a volatility, an underlying where the calls would be more expensive than the puts? Or it might be even? Just type it into the chat. What other oil? Crude oil, a great example. Gold, another great example. Let's take a look at crude oil. Okay, I'm going to put in TL. And, okay, let me come over here. Let me come to the options. I don't want to, okay, we have 3 series. That's enough, but it's a, let's just take a look over here. Let me make everything smaller. Okay, so take a look at this. This is much more of a smile than we ended up having before. Okay, gold is another one. Oh, wrong. I didn't want the D in there. I just wanted the. Let me just do GLD without the futures. Okay, it's going to be another one. And again, I can take it out, but you can see here that it's more symmetrical. I'll give you one. How about treasuries? Think about treasuries. What happens with U.S. treasuries? Okay, what happens with U.S. treasuries is that when there's fear all over the place, okay, what ends up happening? Okay, what ends up happening? Everybody wants to buy treasuries because they're safer. Hence, okay, buying a call in a treasury, at least from a fear perspective, not from what's going to happen with interest rates, from a fear perspective, kind of acts like buying a put in the S&P. And what will happen is that here's one where when there is a lot of fear in the market, what you'll see is that you'll see the implied volatility of this side move up much, much higher. Okay, so the skew will change in different things. Okay, again, so I just want you to end up understanding how implied volatility works and what we can end up seeing, okay, in our trading. Let me go back to here. Let me go back to questions. Am I sure it's not set? Okay, yeah, I end up having, okay, I had that, okay. I've already discussed this, the closeness, okay, of the different futures. Okay, yeah, I have discussed the futures. The last thing I wanted to cover here, and Tom, I don't see my time. I have just a little bit, and so I think we're scheduled well here.
Yeah, we're a little over, Jim.
Oh, we are, okay. The last thing I want to end up talking about is kind of why things have changed with the computer-based guys. Okay, what's happened with the computer-based guys and the trading is that now the implied volatility of these things can end up moving in a much faster area. Where before, if I go before, say, 2008, the entire skew curve would end up moving. It wouldn't end up changing its shape as much. Would implied volatility go up? Yes. Would things, but things went much more according to the way they would normally end up working. Now what happens is that with the speed at which the computer-based guys can trade is that the implied volatilities of these things will end up changing. Okay. Let me give you one example of why put skews are steeper today than they used to be. Remember, when I say put skew, all I'm saying is that the implied volatility of these options below the money compared to at the money, why there's a big difference. Computer-based algorithms, high-frequency traders, okay, make their most money when there's movement in the market. They love to see the markets move in one direction so that they can load up, okay, on their contracts, okay, and their futures, ride it for a couple of points, and then get out. Do they make money scalping, one tick at a time? Yes, they do, but their real money is made when they can end up actually establishing a position and ride it for a few points. So knowing that we've already discussed that the markets do move down, generally do move down faster than they move up, they can normally make their most money on big down days, okay, with huge sell-offs, okay. Now, when that ends up happening, okay, they'll make their most money. If they stay in a small range, okay, they're not going to make as much money, and they can even lose some money getting chopped up. But the high-frequency guys are so good and so fast that usually they're going to have, days that their flat days means that they paid for their commission, they paid their expenses. Their great days are when they end up moving. Now, how do you end up helping your P&L and normalizing your profits a little bit as a high-frequency trading firm? What trade could you put on where you'd lose some money if the market crashed, but you'd make a lot of money if it stayed anywhere close or it went up? Selling a put vertical, right? So by selling a put vertical, you would end up selling options that are near the money and buying something that's much further below the money. Where? The answer is wherever you had the best price. Where do the high-frequency guys do it? Wherever they can get the absolute best price. And so what are they doing is that they know that they're buying options below the money and they're selling stuff near the money. And so they're constantly trying to end up, collecting money, selling put spreads because they are so, basically it's a hedge. It's a little bit of what they do, but they're high-frequency guys, which means that they're trading just an enormous amount. So what this has a tendency of doing, and what has happened over the years, is that Black Monday in 1987 ended up changing this, so it wasn't any symmetrical anymore. 2008 pushed these things higher. Now the high frequency guys are moving this even more so. And so what ends up happening is that sometimes we're seeing the markets sell off, but the put skew not get as flat as it used to. Where things end up changing, and what's always hard, is that you can always see things under stress, okay? The problem is that if you're watching this stuff and you have money on the market and you're under stress because things are moving all over the place, I can guarantee you don't have time to end up watching how these things change. Going back and taking a look and seeing how they change is enormously helpful to be able to understand what ends up happening and how things end up changing in time. That's it, Tom. I don't see any more questions, but without doing math, I wanted you to understand some of the reasoning behind things, what to end up looking for, how it ends up affecting your trading, and how you can end up taking, at least an example with the put spread, how you can end up taking an advantage of you need to end up trading the markets that you end up seeing. And the challenge that I end up seeing that most beginner and intermediate traders have is that they have a set of rules that they've back tested and they believe in them because they entered this trade with 63 days left to end up going, and when their deltas got to this point, they ended up doing this, and that's the best way to end up doing it because that's what the back test said so. Well, that's what the back test said in a particular environment. Today, environments change more, and there's no guarantee that, you know, the implied volatility and the difference, okay, of the IV of one option versus another is going to have that same relative relationship of what you did when you ended up backtesting it the 12 times before, 2014. It doesn't mean that it's going to be repeated just because you tested it back in 2016 and now the same thing's happening. And so you really kind of have to understand and do your what-if analysis and take a look and see how bad things can end up getting in bad situations and how good they end up getting. I will do one last shout-out, and then I'm done here. And that is Paul Demers has built a skew tracking piece of software in Excel, and we're trying to see what we can end up doing because it is, for the way we trade, it actually gives me better information for me to end up trading my trades than Vol Edge or Risk Edge. To those of you who don't know it, it's from a company called FT. The list price on the two tools are about $8,000 a month. They're only used institutionally. What Paul has done, he's taken the one piece of the tool that I needed the most, and he's blown it out, and he's actually giving me better information on it. We're trying to see if we can end up offering it as a tool, but right now it's just a, and don't bother him, by the way, because he's not going to end up sending it to you. He's not going to support it. Do not send him emails when we're ready. Okay, we'll end up coming back to you guys. But that's the type of effort that I think that people need to go. There was one last question here, Paul. Can I tell me why my IV is a difference from the one that I end up seeing on May 16th, on May 26th? The answer is I don't know. When you take a look at this, let me end up telling you just one thing. When I take a look over here, for those of you who don't know this, if you come and you take a look at, sorry, is it here? Oh, no, I'm on the wrong screen. I have to do it over here. If you go to your setup screen, let me show it to you. Okay. If you go to your setup screen on your home page, setup, application settings, okay, and then if you take a look at, I think it's calculations, right? Underneath calculations, there are different ways you can, okay, have, think, or swim, calculate your information, okay? You can have them do a smile approximation. Do not do this, okay? It will not end up yielding what pricing will really end up trading for. But what they basically are doing there is that they're taking the lines that we showed, those curved lines, and they're trying to approximate it into a single smile. And it will end up telling you that if things are traded in this perfectly modeled world that Thinkorswim has built for you, this is what it would end up trading for. It's interesting to see how the options pricings change, what they end up saying, what their implied volatility was, but it's not useful. Okay. Fixed price ends up saying, hey, every single options trades at the same implied volatility. Yeah, that's never going to happen. That's useless. And this one says take the implied volatility of each and every individual strike and then end up using it. Where Thinkorswim, as just about everybody else, I know that OptionView tries to end up doing this. They try to end up saying that if volatility, let's say if the market drops 5% quickly, well, not only will volatility go up, but the change of the smile or the shape of the smile might end up changing. Don't bother, okay? You're using somebody else's model. You're probably much, much better off. What I end up doing is that I don't use any of that. I use just the pure Black-Scholes, okay, or the options pricing model in Thinkorswim, use the individual pricing model, and then from experience you end up learning, okay, if this happens, this line's going to be a little bit more, this line's going to be a little bit less. To me, that was the way I ended up learning. It was a much, much stronger way of doing it. Okay, but I always leave it on individual implied okay? And that was the last question, Tom.
All right, Jim, very good. Thanks very much for that detailed analysis of volatility. I'm sure it helped quite a few people.
And I didn't take out my calculator or talk about numbers practically once, okay, in terms of mathematics.
Certainly not. All right, Jim, thanks again. Thanks, everyone, for sticking with us. I'll get this posted as soon as I can in the members area.
Thank you, everyone.